Hello again and welcome back to London. By the end of the week, we'll get a more clear indication of how aggressively OPEC will go after the shale producers. I've been speaking about all things oil with Jeremy Stretch from CIBC. There's so many dynamics of this OPEC meeting coming up. I've been trying to get people to say that OPEC's going to be aggressive in this meeting, that they're really going to attack the shale producers and also put pressure on Russia. Do you think there's any chance of an increase in output from OPEC?
I think it's relatively unlikely. That's not to say it won't happen, but I think it's relatively unlikely. Well, one would suspect that they will maintain production as they did back in November. Of course, we have other underlying dynamics to consider in terms of the broader supply picture, because, of course, those Iranian nuclear negotiations are coming or appear to be coming to a conclusion, and that, of course, could see Iranian oil coming back onto the market in far greater quantities relatively soon. So I would suspect that that will probably maintain inertia as it stands, but obviously with the proviso that perhaps OPEC could look to increase output further down the track in order to maintain pressure on some of those external producers.
I thought the leaked statement was really interesting. OPEC basically said the only way shale is going to suffer is if there's long-term low prices. Is that an indication that OPEC is learning to live with shale, or do you think they're going to actively try and keep prices low?
I think we can probably see a degree of mutual coexistence. I think, clearly the dynamics in the market have changed substantially over the course of the last few years, and I think now the producers who have had a relatively clear market environment for the last 30 years or so are now starting to see a slightly different market dynamic, and I think there is room for coexistence. Of course, that is reliant on global demand remaining relatively robust, and of course for that we need to see global economic growth maintained, and that of course is the other underlying dynamic which is integral to the process.
As I'm at CIBC, it's nice to be able to talk about Canada. The data coming out of Canada has been it's not particularly strong at the moment. Obviously it's strongly linked to energy prices. Is there anything that Canada can do, especially in terms of the Bank of Canada? Will we see any action there to try and boost stimulus there?
Well, of course, we have seen a significant impact on the Canadian economy from the fall in oil price, predominantly via the cancellation of capital investment in the key oil producing regions. And of course, that then has knock-on effects in terms of employment, but also in terms of fiscal revenues and underlying royalties. So clearly that was the catalyst for the Bank of Canada putting in that insurance cut right back at the beginning of the year. The bank have very much discounted a very sharp deceleration at the start of this year, but expecting the non-energy sector to rebound and to offset the weakness in the resource sector as we go through the course of the year. So I think the bank will be very mindful of any underperformance compared to their plans, and I think that will leave them at risk of considering further monetary policy insurance, i.e. cutting rates, but I don't think necessarily they will have to pull that interest rate trigger as it stands currently.
Yeah, Friday is just super interesting. We've got Greece, we've got NFP data, we've also got OPEC going on. When we all switch on our computers on Monday morning, what do you think is going to be the main theme in terms of the currency market?
Well, I think if we assume that the OPEC meeting will be essentially largely unchanged, then I think we will then come back to look at the underlying dynamics from the US side of the equation, because of course non-farms are integral to expectations of when or if the Fed will be tightening this year. So I think if we see a reasonable payrolls print, something in the region of 225,000, but also showing some signs of earnings growth, then I think that will keep the US dollar relatively well supported. From the Greek scenario, one suspects that will come in on Monday morning, and even if the Greeks can find the funds to pay the IMF on the 5th, I think we'll probably still be discussing a degree of debt resolution which is ongoing rather than coming to any absolute conclusion. Yeah,
I just want to quickly finish off on the US economy, because that NFP data does seem to be especially key, as we saw that quite big downward revision in US GDP. There's economists falling over themselves to saying that everything's okay with the US economy, it's not that bad. What's your take on the situation there?
Well, that's right. I think we've had a lot of cross currents over the course of the first quarter and the first 6 weeks or so of the second quarter. I think we can argue there are specific factors which impacted Q1 in terms of obviously the bad weather and the port strike, and we haven't seen necessarily the pickup on the consumer side, or it appears, at least ahead of the auto sales data, we haven't seen the pickup on the consumer side that we would have assumed, particularly in relation to the benefit to the consumer from low oil prices. But with those auto sales on an annualized basis up at levels we haven't seen in 10 years, then I think that is consistent with a durable bounce in the economy during the second and into the third quarters, and I think that's going to suggest that the weakness we've seen initially in the year will prove to be transitory, and we will see enough evidence over the course of the next couple of months for the Fed to consider a September tightening.
We're always good to catch up with Jeremy. Stay tuned for more interviews and analysis, but from London, goodbye.